So Marcelo Lima is the founding and managing member of Heller House, a fund based in Miami, where the weather is always nice and warm. I was introduced to Marcelo through a friend that I have deep respect for, and that is a great student of investing himself. And my friend told me that I need to read some of Marcelo's letters. And so I did, and I quickly learned that Marcelo is really a brilliant investor and also a learning machine. And so I thought it would be a great opportunity to hear about Marcelo's investing strategy and his process, because so many of his holdings are also some of our highest conviction ideas here at the Motley Fool. And so Marcelo, we're thrilled to learn from you today. Thank you for being here, and I'll turn it over to you.
Well, thank you, John. I'm thrilled to learn from you because, as they say, the best way to learn is to try to teach something, right? So I wanted to motivate this short presentation with a few phrases that I sort of have engraved in my brain. So the first one is strong opinions loosely held. This one is from Mark Andreessen. The second one is, in the beginner's mind, there are many possibilities, but in the experts, there are few. This is I think it's a Buddhist saying from Suzuki. The third one is from Munger, Charlie Munger. Any year that passes in which you don't destroy one of your best loved ideas is a wasted year. Then there's a great book that I really enjoy called Super Forecasting by Philip Tatlock, and there's a chapter there called Perpetual Beta. And finally, Jeff Bezos has this idea of it's always day one. And what I think all of these phrases convey in different ways is that we always have to have a very flexible mindset, because the world is always changing and we have to change our minds frequently if we want to be right. So everything that I'm about to tell you is sort of, I feel like it's always work in progress. It's always perpetual beta, and I'm always trying to learn and improve. So I'm just going to share with you some things that are top of mind, and we'll go from there. So John sent me a list of questions of things that might be on people's minds, and I'd like to go through them and give a little bit of a blurb on each one. So his first question was, what's your portfolio management strategy? Concentration, position sizing, risk management, etc. So, I'm a big fan of the Kelly Criterion. This is as probably most of you know, it's based on information theory. Claude Shannon and Ed Thorpe was the first successful practitioner of using the Kelly Criterion to size positions. And it's a very simple formula. It's basically says the fraction of your portfolio that you should put into a stock, and this is one implementation of it, is you take the probability of the upside divided by the percentage loss that you expect to have if the investment goes sour, and then you subtract the probability of loss divided by the percentage gain. So let's talk about an example. Let's say that you have a stock that has, you imagine it will have, let's say, 60% upside, 30% downside if it doesn't work out. The probability of winning is 60%. The Kelly Criterion then says, put 133% of your portfolio into this stock. And the reason why it says, lever up to invest in this is because there's no scenario in the example I gave of 100% loss, right? Obviously, reality is not that simple, but even if you use the same numbers I gave and you put downside of 80%, Kelly still says put 8% of your net worth in a stock. So I like to play around with these numbers and figure out, what the optimal betting strategy is for a particular investment. And as you know, Kelly Criterion, it's extraordinarily volatile, but it's sort of the way that the methodology that guarantees the fastest rate of growth for your wealth. Very hard to do in practice, but I think it gives you interesting guardrails. In practice, I tend to overweight positions that I believe are low risk, very low risk, and have high expected return. And then I tend to underweight positions where I feel that I love the business, I love the management team, but I still have questions about where the business model is developing, the product strategy, competitive pressures, whether margins will end up being what I believe they will end up being, et cetera. So I don't think that you have to go all out on every investment. You can. My opinion is I can size these things differently depending on my conviction level, and then over time make adjustments to the portfolio depending on the risk rewards as I see them, as I follow the companies along every quarter and every year. In terms of portfolio management beyond that, there's a paper that I find fascinating by Hendrik Bessenbinder called "Do Stocks Outperform Treasury Bills?" And he noted that in the 90-year period from 1926 to 2016, only 4% of stocks listed in the United States generated all the net wealth during that period. So there's a very strong power law distribution of returns. And this is a strong argument, I believe, for focusing on what I think are sort of the inevitables, the very strong businesses that will keep growing for many, many years. Of course, they are easy to identify ex post, hard to identify ex ante, but that's what I think makes investing interesting and challenging. From an evolutionary perspective, let's assume that the S&P 500 is all there is. If you imagine the S&P 500, it's a market cap weighted index. So it tends to, if a stock is winning, it tends to overweight that stock. You can think of it as a ranking method for who's winning in the global economy. And so I like to think of my portfolio as I have all of these different organisms, if you will. They're all competing in the jungle of the global economy. And I want to follow the companies every quarter and figure out what companies are winning and what companies are losing, and then weigh the portfolio according to that. And I want to sort of be very exposed to the companies that are obviously winning and I believe widening their moats and really becoming inevitable over time. Now, I'm very cognizant of reasons why active managers underperform. There's an interesting paper by J.B. Heaton about this, and he cites three interesting reasons. The first one is that, let's say you have a portfolio of only 5 stocks, and you're being compared with the S&P 500. There's statistically a very low probability that the 5 stocks you picked are going to be the winning stocks in any given year, and you're competing with 500 stocks, and you might be missing a few very large winners that are skewing the index. And so it's actually very hard to compete with a very concentrated portfolio. I still think concentrating is a good idea, but you have to make sure you concentrate in the right stocks, which is obviously challenging. The second reason why investors underperform is systematic bias. So let's say you, for whatever reason, you think it's morally wrong, let's say, to invest in tobacco stocks or defense stocks. If during a decade, those are the big winners in the index, you might be, again, left behind because you were not exposed to those big winners that skewed the index's returns over a decade. But the third reason I think is actually the more interesting one, and that's that investors tend to sell their winners too soon or trim their winners too soon. And I think that's very fascinating because, again, if you tie this back to the Bessenbinder paper, over 90 years, I believe he has a ranking on the back of his paper of like the top winners. I think number 1 was ExxonMobil, and number 2 was General Motors and Apple, and et cetera. Imagine if you had sold those stocks along the years because you're like, well, it's too big a part of my portfolio, et cetera. You would have given up a lot of that wealth creation over time. And the example I'd like to give is, Amazon went public 22 years ago. Imagine if Jeff Bezos had said, Amazon stock is too big a percentage of my portfolio. I'm just going to trim a little bit here. If he had done that along the way, he would have today a fraction of his wealth. So, I'm inclined to behave in a certain way in terms of portfolio management. That if I'm riding a rocket ship, and the rocket ship continues to have great trajectory, then I want to stay on the rocket ship. So that's sort of my current thinking on this topic. The second question that John asked, I don't know if you want to interrupt me with any questions or just leave it for later, but feel free. The second question that John asked me is if I use an investing checklist, and if I could share a few of those. And I have this big list of things that I look for, but a few of the big items is I'm looking for technology adoption curves, and these adoption curves occur in just about every technology you can imagine, going back to the Industrial Revolution. So you have things like electricity, indoor plumbing, automobiles, airplanes, TV, radio, and then more recently the internet, social media. They all follow these S curves, and then the idea is to find, so those adoption curves give you the general trends and the sort of the growth of certain technologies in the economy. And then whenever that happens, there's always several companies that benefit from those, and they might be primary companies. So let's say in the case of the automobile, if you were an early investor in Ford and General Motors, you did well. I'm not a huge fan of auto companies. But there's also secondary and tertiary investments that you could look for, derivatives that do very well. So in the case of the automobile, Walmart is a business that was uniquely enabled by the automobile. It was founded in the 60s. And then Geico is another phenomenal business that was uniquely enabled, obviously, by the automobile, because you needed car insurance. And that was founded, I think, in the 40s. And famously, Ben Graham said, sort of 25 years after he invested 20% of his fund in Geico, he said that one stock made more money for us than everything else we did combined. So it was sort of that one, big winner that really skewed his portfolio. So I'm trying to pack my portfolio with Geico's. So companies that are riding these adoption curves that I believe have some sort of disruptive approach, that have a widening moat, that have phenomenal management teams. And in terms of management teams, I used to not really care about culture very much, et cetera, but today I'm sort of the complete opposite. I tend to overweight culture, and I believe it's extremely important to understand the culture of the business, how they hire people, what the management team looks like, do they have the right people in the right positions, so that they can have an effective sales team, an effective go-to-market strategy. How are they thinking of product development? How are they thinking of investing in adjacencies? So I think all those things are extremely important. And I like to be in businesses where I have a missionary at the helm, not a mercenary. And an example of a mercenary, and I'm not going to name any names, but if you look at certain consumer packaged goods companies that are very mature and that have been performing very poorly recently, some of those have managers at the helm who are just sort of hired guns, right? They come in, they manage earnings per share to go up a little bit every year, and then they retire after 7 years and get their golden parachute. That's not the kind of manager that I want. I want the manager who's willing to really invest for the future, who has a vision, and is willing to give up current earnings for the benefit of the business long term. And many times that is the correct thing to do. So there's also one question that I have in my checklist, which I think really focuses the mind, which is, would I go work at this business myself, taking 100% of my compensation in stock? So if the answer is yes, right, that's a business that I want to own. So there's a bunch of items in the checklist beyond that, but sort of these are the big ones. So another question that John asked me was, how long do you typically research a business you're not familiar with before you're comfortable deciding to buy the stock or not? So there's obviously no set rule for this. It could be months, it could be weeks. What's interesting, if you focus on technology, which is what I'm doing now, is there's a lot of knowledge transfer that happens, right? So once you learn certain concepts in certain companies and industries, you can then transfer that knowledge over to new companies, and it becomes a lot easier you build this mental framework that allows you to then say, okay, this looks like this organism, this animal looks a little bit like that animal. It's a little bit like paleontology, I imagine, or comparative biology. So you can sort of start understanding these businesses in the context of each other. And then a follow-up question to that is, what does your research process include beyond reading the company filings? Do you speak to management? Do you attend conferences? And the answer is yes, all of the above. I think it's extremely important for me to get as close to the company as possible, to really understand the customers, talk to employees, listen to interviews, podcasts, meet with the company, meet with the customers, use the product as much as I can. In some cases, it's easier than in other cases, obviously. But I have to have this mental model of the DNA of the company, like how the CEO thinks, how the management team thinks. I think that's extremely important to understand. And I also think it's very important to understand the context of this company in the ecosystem. So very important to study the competitors, because when you're studying a company, you have a lot of confirmation bias. You're going to hear, obviously, only the best things coming from management. If you talk to customers, those customers by definition like the company, otherwise they wouldn't be customers. So try to get out of that bubble and try to look at opposing viewpoints. Well, who are the competitors? Who are the customers of those competitors? What are they saying? And try to get a better view of the business. And sometimes you're studying a competitor, and it turns out the competitor might be a better investment than the one you're looking at originally. So I think having this contextual view of the competition is extremely important, because you're sort of if you're touching a competitor in this ecosystem, you might be sort of the blind man. The parable of the 5 blind men touching the elephant, and one guy's touching the tail, one guy's touching the trunk, and the guy touching the tail says, "Oh, this is a snake," and the guy touching the trunk says, "No, this is a tree," right? And nobody really knows what's going on. So I don't want to be the blind man. I want to sort of have different viewpoints so that I can properly evaluate what it is that I'm looking at. So another question John had was, what's your preferred valuation method, DCF, free cash flow yield, or private market value? And again, I think it's important to have many valuation methods, many different models, and not just one, because I think you use different tools for different companies and at different points of their life cycle. If you're looking at a very mature company, it makes, I think, less sense to think, well, to sort of model this company out and think about different monetization levers and margins at maturity and that sort of thing, because the company's already mature. On the other hand, if you're looking at a very young company that's still in very high reinvestment mode, especially with these SaaS companies, have very high upfront costs, but also tend to have very high margins, you have to have a sense for what the margins look like at maturity. And so I love doing discounted cash flow models, and I love sensitizing the variables. So figuring out what are the different growth rates that I can envision for this company, what are the different levers for monetization, so what can the trajectory of that revenue be and why, and then margins over time and why those margins make sense. So a company with 85% gross margins that has a certain investment in sales and marketing, R&D, et cetera, should have very healthy free cash flow margins at maturity. If not, there's something wrong. So you sort of have to understand what the model looks like. And that gives me sort of the margin of safety. I can then back into what the current market price is implying. So a company that has, using my DCF, I can then say, wow, the market is implying an astronomical growth rate. I can't get there, so I think there's no margin of safety here. Or I can back into it and say, you know what, the market is actually implying not a very aggressive growth rate and actually lower margins than I'm expecting. This gives me a very big margin of safety, so I don't have to make any heroic assumptions to underwrite a very high internal rate of return. So those are sort of the guardrails that I look at when doing a DCF. And then those are pretty much the questions that John asked me. So I think it's we can open up for Q&A if you guys would like to ask any questions.
Hey Marcelo, I'm Tim Byers, and I'm in Colorado with John, but I'm at our Lakewood office. Thanks for coming. This is great. I'm just curious. I have many questions, but I want to focus on this one. You said you switched from, you didn't spend much time evaluating management, and now it's very, very important to you. What necessitated that switch for you? How'd you get there?
Yeah, so I'll give you some background. I spent a lot of years doing the Ben Graham type of investing. So I used to do a lot of liquidating trusts and companies that were sort of worth more dead than alive, but has some sort of catalyst. And I'll give you an example. This is sort of one of our greatest hits. It's a company called DRA CRT Acquisition Corporation. I'm not going to give you all the dirty details because it's just going to bore you, but basically it was a structure that owned a bunch of office buildings. And if you looked at the equity, and this is all, I had to sort of figure this out because there was no financials. The company was dark. If you looked at the equity in all of the office buildings, it was something like, $50 per share. This is per preferred share. And you could buy the preferreds for about $6 to $7. So you had this enormous margin of safety. The management was actually antagonist to us. They were not friendly. They were not on our side. But the legal structure, because this was a cumulative preferred stock, it was sort of a toll booth stock security. They had to pay us if they wanted to upstream any capital to the equity. They had to pay us first, and it was accumulating over time. And so, unless there was fraud involved, I didn't really care about the management. That's an extreme example. In a less extreme example, I've been in situations where there's a liquidating trust trading in London. They own real estate. The board of directors was replaced by an activist hedge fund, and they're selling the real estate and distributing cash. In that case, I do care about management, but I care about management in a very limited sense that, are you guys going to sell the real estate properly and distribute cash, and how soon? So I don't care about the culture. I don't care about who they're hiring, if they have a good go-to-market guy. Oh, is there a sales guy? The guy from Salesforce, that sort of thing. Whereas now, if you're investing in these perpetuities with very long expected lives, companies that we all like Twilio, Shopify, Slack, etc., it's very important to understand all these things and the culture and all that. Whereas previously, it didn't matter as much for me.
Hi, I'm Ben Raw, and thank you very much for that talk. It was very, very illuminating. So going back to the Kelly criterion, have you ever tried weighting the different Kelly the calculations that you get for your portfolio? So if you have say a 4-stock portfolio, and each one gives you 100%, then you put 25% into each stock. Have you ever tried that?
Yeah, well, so that's essentially what you do, right? That's essentially what you're doing by building a multi-stock portfolio. I'll give you an extreme example. There's a paper by Ed Thorpe from 2007 where he goes through these examples, and then he uses Berkshire Hathaway as the example. And there's an implementation of the Kelly criterion that uses standard deviation, so like a proxy for volatility of the stock, and also the risk-free rate of return, so you can calculate the delta between the expected return of the stock and the risk-free cost of capital, so you can figure out how much to lever. So if you plug the variables in, and of course this is ex post, this is after the fact. So if you look at the historical returns of a Berkshire Hathaway stock, the historical volatility, the risk-free rate of return on treasury bills, and you plug that into this implementation of the Kelly criterion, you get a result that says you should buy Berkshire Hathaway stock and lever up 6x, which is crazy because there's discontinuities in the stock market. So you might wake up one day and the stock market might be down 20%, like as happened in 1987. And so you don't want to do that. So in the paper he says, well, maybe we limit it to two times leverage. Maybe that's the optimal solution for this situation. The trouble with that, obviously, is that the future is uncertain. You don't have ex ante knowledge of Berkshire Hathaway. Ed Thorpe arguably did. He bought Berkshire Hathaway at about $1,000 a share. So he saw it relatively early that this was an exceptional individual. He had met Buffett about a decade before that, and he had sort of forgotten about it. So he sort of knew this before the fact, that he did very well as an investor in Berkshire Hathaway. So. But I still think that there's something to be said for diversifying, which is what you're advocating. Instead of having one stock, you have 4 stocks, and maybe you have 5 stocks, et cetera. And then you would divide the Kelly formula according to what you said. I believe that that's a perfectly valid argument, and I think it's actually prudent because, again, the future is uncertain. The probability that you're going to nail a Berkshire Hathaway, right, 30 years before that huge run up is very low probability.
Hey Marcelo, my name is Buck. Thank you for sharing that. One thing you just might find interesting, I don't know, have you ever heard of Jerry Basil by any chance?
Jerry Basil?
Yeah. He was head of research at Princeton Newport, and he worked here at the Fool and ran a fund for us for a little while. He was a professor, so he knew Ed very well, and I actually started our analyst development program, and we kind of talked about Kelly Criterion. But anyhow, I was fortunate enough to sit down with Jerry and talk with him a little bit about it, and he did say that Ed never used it. He never used it in investing, and he kind of went through and explained why. And you kind of, I think, touched on that a little bit. We don't have perfect information. It was a formula that was built for using perfect information, and although Ed had wonderful returns, and I think he did scale things accordingly, as you said, with risk versus return. And some people have said, we use quarter Kelly or half Kelly or whatever, 1/10 Kelly or whatever, but he said Ed never used it, and he wouldn't have ever used it for stock. So anyhow, I just thought that would be kind of interesting that you might.
Yeah, I mean, I also, it's funny, I had the opportunity to speak with at times, and I think that it's more guardrails, but also I think it's useful in certain situations. So I have found it, and I don't do much merger arbitrage today, but I feel that it's very useful in merger arbitrage, because in merger arbitrage, you sort of you have a better idea of what the stock will be if the deal goes through, because you have a set price for the deal frequently, not all the time, if the deal is in stock. And you also have a rough idea of where the stock will be if the deal does not go through, because you might say, well, maybe it goes back to where it was before the deal was announced. Again, assuming the business is not deteriorating, that sort of thing. And then you can sort of figure out the probabilities according to, is there regulatory risk and all that. So I feel that it's useful in that situation. I also feel it's useful in the liquid trust. I feel that results are so that really are not that practical, because they'll give you, in most, I think, real world examples of good businesses that you're investing in, they give you insane results that you should put more than your entire portfolio in a stock, and that's just not practical.
Yeah. Have you ever read 100 to 1 in the Stock Market by Thomas Phelps?
Yeah. Oh, I have the book. I actually haven't read it yet.
Okay. It's a great read, and I think it ties in really nicely with some of the concepts and S-curves and things that you're kind of talking about, because he looks back, and it's an much older book, obviously, but it looks back at the stocks that have gone up to be 100 baggers over time and tries to pull out some common themes in those stocks, which there's not much. It kind of comes down to the winners keep winning, right, and kind of identifying those stocks. But anyhow, there's some interesting rules in there that might be of interest.
Just a follow-up really quickly. So you said you sometimes ask yourself in your checklist, would you want to work at this business for stock only? How many times have you answered that question yes? And can you give us a business where you've answered that question yes? Yeah,
absolutely. So, like a big business that I would totally take stock and compensation, Amazon is a great example for me. Facebook is another great example for me. And then a smaller business that I really like is Slack, that I'm a big believer in. So I think everything that I own is something that I would absolutely be willing to take stock as compensation. And sometimes it's puzzling to me to see insiders selling. On the one hand, on the other hand, I do understand that they've been illiquid for a decade in some cases, and they have needs for liquidity and that sort of thing. But I think that there is a big picture. I think that there is so much future left for these businesses that I think taking compensation in stock is a great idea. And yeah.
I agree with you. I own Slack, so I agree with you on that one. So yeah, great, interesting.
Marcelo, on the call, I think you've mentioned Shopify, Slack, Twilio, Facebook, and Amazon. all founder-led businesses. Is that a criteria of yours, or is it just an outcome of everything else that you look for? And if not, how do you come across ideas? If you're not looking for founder-led businesses, are you looking at what other investors that you admire are buying? Where are you getting your idea flow from?
Yeah, so it's I like to steal ideas from other people, and this idea of the founder-led business I stole from Tom Russo, who I really like and admire. And as you know, Tom, early in his career, Buffett visited him at his class at Stanford and talked about this problem of agency costs, and said, "Look, you're a minority investor in these companies, and you want to make sure that the management team is on your side." And a lot of times that meant family-controlled businesses. In other cases, it meant really management teams that were able, the way Tom puts it, they were able to burden the income statement today for a future payout. And so he likes to use the example of Nestle investing in Nespresso coffee, billions of dollars spent in R&D, et cetera, to develop a business that would be much larger in the future. And there are many such examples in his portfolio. What's interesting to me is that as a lot of these businesses become more mature, they tend to hire, for whatever reason, they tend to hire a lot of mercenaries. And so you might end up with management teams that look more like those management teams from the bad CPG companies that I described, where all they're doing is they're managing EPS and getting a golden parachute when they retire. So I think that there are so many great companies today that are founder-led that it just became a good hunting ground for me. It's not something that I require, but it's something that I absolutely like to see because I like the fact that there's an owner there. I like the fact that there's a guy who cares, who is incentivized, hopefully incentivized to grow the business responsibly, and to think about product strategy, and to hire adequately, and to make investments adequately. And then you have to gauge if their actions really match that ideal. And I think that in the ones that I cited, I believe that the answer is yes. Now, as far as idea flow, and I'll look at everything. So I'm always looking at existing companies. I'm looking at competitors. I go to conferences and I talk to all the private companies that are there, because eventually those private companies might become public, or they might end up as an acquisition of a public company. So one example is Signal FX. I've been seeing them at conferences, and they got acquired by Splunk recently. So another example is PagerDuty, that I sort of met a few years ago, and they explained what they did, et cetera. I mean, lo and behold, now they're public. So you never know where these companies are going to end up. They might end up as a subsidiary of one of your investments. They might end up as a subsidiary of some other company, or public themselves. And so I'm always looking out for new things to try to understand, again, the ecosystem, the competitive dynamics against my companies, if my companies are going to get disrupted by anything, and really try to understand the sort of the moving pieces on the chessboard.
Marcelo, hi, thanks. I'm Andy. The beauty with investing, I think, almost more than almost any profession, is as our friend, fellow investor Ron Gross likes to say, it takes two to make a trade. There's always, for every piece of data, there seems to be a data point arguing the exact opposite. So here's one that I wrestle with a lot. So we're fans also, Professor Bessenbinder's study from ASU on the 4%. But also, if you look at historically, the data is for the average company is not so good. They tend to underperform the market. Furthermore, a lot, there's a JPM study that talks about how 40% of the companies actually, over a long period of time, will lose a good chunk of their value from their peak performer. So I balance that off with companies that not all companies grow to the sky. The few who do can be totally game-changing in a person's portfolio. So my question is, how do you balance the fact that there's a few companies in your portfolio, and some may end up doing exceptionally well, and some may just flail out, How do you manage that over time when you start to see companies maybe start to struggle a little bit? Maybe the performance isn't quite as robust as it used to be, and there may be some stagnation with the fact that certainly Apple and General Motors and Facebook and all the ones you mentioned that are some of the biggest gainers have gone through those struggles in the past, while others have struggled and they've just collapsed.
Yeah, that's a phenomenal question, Andy. And I every once in a while I'll find one of these stories and I'll tweet about it and I'll say investing is hard. And it was a recent example, and I'm actually going to try to find a tweet here as we speak, but it was on Adobe. And Adobe, as you know, has been a phenomenal performer, but like a lot of these technology stocks sort of hit a peak in 2000 because the market was very overvalued. So here it is. Adobe stock delivered a compounded annual return of 24% from September 1986 through the end of last month. And this is October of 2019. So 24% compounded. That's, amazing, right? But there was a 13-year period during which the stock went absolutely nowhere, right? And that was 2000 to 2013. And I wrote, investing is hard. And I don't know enough about Adobe during that period because I can't tell you if it was just overvalued or if it was overvalued and mismanaged. We know that that's the case for Microsoft, right? Microsoft was overvalued in 2000 and it was subsequently mismanaged quite a bit until Satya Nadella took over. So it is such a challenging thing. You have to really have this flexibility of mind, I think, to be able to change your mind and be able to identify, when the management team is not doing things that are appropriate for shareholders, as you could argue was the case with some of the, I believe, very ill-advised moves right during the Steve Ballmer era at Microsoft. And then again, identify when there's an inflection there. Adobe moving to software as a service, Microsoft with Satya Nadella, and really taking advantage of the very low valuation and the fact that there was perhaps a lot of optionality there. So that's a phenomenal question. It's something that I have to learn, and I think we all have to learn as investors because it's extremely challenging to figure out which companies are going to go through struggles and then do extremely well, and go through struggles and then just die. So it's if it were easy, I think we would all be extraordinarily rich and and just counting our cash right now instead of chatting. But it's definitely a challenge, and I hope I can learn more about it, from you, and we can share more ideas on how to solve this problem.
Yeah, well, I clearly did. I sold Microsoft 5 months before Satya was hired as a CEO, and I was just like, oh, God. As soon as that announcement came through, I was like, this is just not going to be good for my portfolio. Historically, So when Satya got hired, did you have a sense that was a game changer for Microsoft? Or? Yeah. Hindsight's always 20/20, and I was not a Microsoft expert nor a Satya expert, but the first time I heard him talk, I was like, he is nothing. First of all, he's nothing like Steve Ballmer, which was a huge advantage. I was like, finally. And then within a year, this is even before the GitHub acquisition, even within a year, you could tell he was just trying to change the culture and bring it back to where it was. And the fact that he had worked on the cloud side and had cloud in his veins. Like the one quote, one of the of many quotes that you've said today that I really appreciate, and I thank you so much for coming and sharing. John, thank you for arranging the call. Is you talked about the DNA of the company. I think a lot of us on the call feel that as we look at these companies that are truly, we want to be able to invest in for years. And I think that concept of understanding the DNA, and Microsoft had totally lost its DNA. Totally lost it. And Satya Nadella and his team that he brought in completely reversed that. And I just felt that from the first. Now, I didn't buy in, so I back, which was my mistake, right? I should have bought back within a year of that happening, because then I would have done very well, having done pretty well in Microsoft in the first case. But just it stagnated, and I just was like, Ballmer is not the person to do that. And he was ingrained in owning so much stock. Been there from the very beginning, even though he was a lawyer in training. I just felt they had lost their way. So, but they found it again, which is good.
Yeah, let me ask you, because this is something that I think every investor struggles with, which is anchoring, right? So, I sold it at 50, now it's at 70, I'm going to wait for a pullback. Do you think you didn't go back into Microsoft because you were anchoring on a price that you sold at, or is there another reason? Because that's a good lesson, right? Like, ignore the historical price. The facts changed. Even though I'm paying a big premium now, maybe now's the time to get back in.
Yeah, it was just antipathy. I was so mad at them for not hiring Satya when I owned the stock. No, I'm kidding. Anchoring. I mean, I think all of us are susceptible to behavioral biases. And our friend Jim Mueller, another analyst, I don't think he's on the call, but he's written a lot about this for our members. I think anchoring is it has to be among the top three behavioral mistakes that investors make. I know I certainly do. I make it almost every day. I see this stock. It's, so I think it takes a lot of fortitude to be able to say, I sold this business or I owned it. Now it's totally different and I'm investing back into it, or I have faith, believe, valuation, whatever it might be. I didn't do it with Microsoft at that point.
Yeah, it's interesting because you mentioned founder, owner, operator businesses, which we love. And, obviously Bill Gates kind of led the way, and then next person steps in who he knows and trusts very well, but doesn't do as well. Though maybe some people could argue Ballmer did some things well, I don't know. But that's an interesting discussion. Certainly Apple had played into as well with Steve Jobs. And I think we found it's hard to make a transition from that, super charismatic leader, visionary person to somebody who's next. I know a lot of folks that don't like, who's the current guy at Apple?
Tim Cook.
Yeah, Tim Cook, and I think they've had some problems with, maybe their ecosystem is so strong, it can kind of overlook the fact that supply guy makes products that have some problems and everything else, and maybe we underestimated some of the ecosystem there. But any questions or comments from you, Marcelo, on those transitions? Obviously, Berkshire Hathaway is a company you mentioned recently. I think 88 and 93 are the two people leading the charge, and we kind of know who's next in line. But any thoughts? And I don't know the folks at Slack and some of those, but who's obviously going through a transition now with Page and Bryn both stepping away from the business. We've seen it happen at Starbucks. Howard Schultz did not go well the first time. Actually, coffee business, you think pretty easy to run, but literally the rails came off the track, or the wheels came off the track there, but it seems to be going better now. So any thoughts on you from kind of transition on those owner, operator, or visionary leaders?
Yeah, I agree with you. It's a super challenging risk. It's not obvious. The Starbucks case study is fascinating. I wasn't very close to Starbucks. I wasn't like a super close analyst of the business to understand what happened there with the transition away from Howard Schultz and then back to Howard Schultz. But you're right. It wouldn't seem that challenging to run a coffee business, and imagine something way more complicated like an Alphabet, Google, etc. We'll have to wait and see, right? There's an argument to be said in the case of Alphabet that Bryn and Page have already been absentee owners for quite a while, and that current management has really held the reins for quite a bit. There's also an argument to be made that maybe now it'll be easier to make tough decisions if the founders have stepped back a bit. They're still shareholders and they're still not actively involved, but there's still sounding boards at least. So we'll have to see. It's very tough. Something like a Berkshire Hathaway is I think even more complicated because there's just so much. I feel like there's just so much potential there, given the fact that there's just so much capital, so much excess capital at that business, and a lot of the businesses are not optimized. Eventually, I think it'll have to become a more professionally managed conglomerate. I would not be surprised if there are spin-offs. I think we see dividend payments at some point soon, and then maybe spin-offs at some point within the next decade or so. Just my 2 cents.
I think. Go ahead.
I was going to say, what's interesting between those three, Alphabet, Microsoft, and Apple, is all three were handpicked. So Satya Nadella was handpicked by Gates and Ballmer. Jobs handpicked Cook, and Page and Brin Pichai is their handpicked successor. So that may mean absolutely nothing, but I find that fascinating that all three of those are handpicked successors of the founders.
Yeah. Mel was handpicked by Welsh too, though.
True. Yeah, I mean, it's the difference with Nadella is. I did want to ask you about, you talked about some inevitabilities, Marcelo, and I think one of the inevitabilities we see in tech that we cover here, at least something, this is my personal opinion, but I think you can see the pattern, is when developers get behind something and when developers are involved, there's a lot of value creation that follows that. And Nadella is a developer. He brought Gates was a developer, Ballmer was not, Nadella is, and he brings that discipline back to Microsoft. So are there some others that you are looking at and tracking now, Marcelo, that are like, these are inevitable things, or these are patterns that I can see that give me some insight as to whether or not this is a business that's got serious tailwinds?
Well, I think the most obvious one that I see today is cloud computing. I've been to reInvent now 3 years, and every time I go there, it just reinforces my opinion that this business has tailwinds. Like, it's just unbelievable. They're building the analogy I love the best is the analogy of the electric utility, where when electricity was invented or discovered, every factory used to have either human power or steam power or a water wheel or something. They transitioned to electricity, and every factory had its own power plant. And along came so you can think of that as on premises. Along came an entrepreneur and Samuel Insull, and said, hey, why don't I run a wire from my centralized utility to you? You'll pay by the minute, and you can get rid of all this equipment and all these engineers taking care of your power plant, etc. And this is like that, but on steroids, because the electric utility sells really a commodity. It's electrons and it's reliability, whereas the cloud sells Lego bricks for the 21st century. These are hundreds of pieces of functionality that you can mix and match and use that to build your business logic and just build just about any application on the cloud with elasticity, reliability, scalability. It's just absolutely incredible. And year after year, you see larger enterprises and more meaningful businesses and businesses in different verticals like healthcare and space exploration and financials, etc., just moving to AWS or Azure or GCP. And it just seems to me like a tidal wave. So I like to think of that as sort of a platform. Like you said, you have developers. It's a developer conference, and this year there were 65,000 developers there, or folks visiting. And it's you just see that ecosystem getting built up, more and more developers, more people getting certified, more applications built on top of AWS, and it sort of just creates this feedback loop that I find absolutely fascinating. So that to me is just a tidal wave. And then of course everything that's built on top of that, right? So all the companies that we discussed here, things like Shopify, Slack, and Twilio are built on top of these layers of cloud computing. So it's just fascinating to watch.
Yeah, for sure.
Marcelo, that was music to Tim's ears. He's kind of our head cloud analyst here, and TJ's on the call working closely on cloud as well. I have a question. So in your long-term compounder example, you mentioned Microsoft and Adobe. Coincidentally, both of them, the catalyst for change was largely driven by Jeff Ubben at ValueAct, constructive activist. So I'm wondering if you ever follow an activist investor into a position that you have a lot of respect for, that you think can drive change and unleash the value.
Yeah, I think as with everything, you always have to think with your own head, and you have to do your own analysis, do your own work, and figure out whether it makes sense or not. we've seen many examples of activist campaigns that have made sense, and also examples of activist campaigns that have made absolutely no sense. So I think it's very important to be critical, like you are critical in any other situation, and not just blindly assume that just because an activist, they frequently have a lot of resources, they frequently manage billions of dollars, they might have invested tens of millions of dollars in due diligence in these situations. And you'll be surprised that that is no guarantee of success, right? And in fact, it could be an enormous failure despite all those resources. So I think very important to think from first principles, try to figure out, underwrite the situation yourself. But yeah, I don't see anything wrong with that. And it might be a wonderful catalyst. And in those two cases, it was absolutely phenomenal what Jeff Ubben did. So absolutely, I think that's a totally valid strategy.
We're almost out of time, but I want to make sure that this doesn't get missed. You just mentioned a lot of these companies like Shopify. They are building a platform that others can build off of. I just think that's a wonderful definition of a platform, because these words like ecosystem and platform get thrown around a lot in the digital age. But I love that visual of what a platform could be, allowing other developers or other businesses, customers, to build off of the platform and scale themselves. So thank you for that.
Yeah, no, maybe you can help me with this, because I was actually, I heard that, so this idea apparently originated with Microsoft, and there's this article that Ben Thompson wrote called the Bill Gates line, as you know, and sort of the line is, a platform is something where people can stand on top of, and where the value of the ecosystem of the people developing on top of the platform, the value that they create is greater than the value that the platform maker extracts, right? And I heard that in the early annual reports of Microsoft, they used to brag about, hey, for every $1 that Microsoft makes, our ecosystem makes $5 or whatever the number was. I've been scouring old annual reports and I couldn't find that. So if you happen to find that, I would love to see it. But I absolutely believe that that's the case. And you look at a case like Shopify, the way that they incentivize their partner ecosystem is very interesting, because if I am a Shopify partner and I refer a store to Shopify, I get a percentage of that subscription revenue for the life of that merchant. So you can talk to partners who have made quite a bit of money from referring merchants to Shopify, and I think it's a phenomenal way to build loyalty with the partners, keep them tied to the Shopify ecosystem. And you can see then all the apps being developed for Shopify. And so you sort of see this economy being built on top of it. And it just provides these reinforcing loops, because if you're thinking of moving to an e-commerce platform, you're going to want the one that has the most developers, the most partners, the most apps, and vice versa. So if you're an app developer, you want to go to the ecosystem that has the most merchants. So it creates this very interesting flywheel.
About 3 minutes left if anyone has a last question.
Yeah, Marcelo, it's something I think about. You talk about how big the kind of trend is for cloud, and how all the big players there are part of these bigger conglomerates, Microsoft, Amazon, Google. Do you feel like the value of those businesses are fully reflected in those stocks, or do you feel like there's almost a conglomerate discount in the fact that these businesses are kind of baked into these big giant companies?
Yeah, that's a very interesting question, and I'll go in two directions. On the one side, what I hear a lot of pushback is these companies cannot all be worth what they're worth right now, because everybody is trying to step into each other's territory. And how is it possible that Adobe has, just to use this example, Adobe has Magento and Salesforce has Demandware, and Shopify is also doing e-commerce. And then you see a lot of companies doing application performance monitoring and log file analysis like Elastic and New Relic and Datadog and Splunk, etc. And the pushback I get a lot is these markets are not that big, and you can't have that many companies doing these things. That's possible on the one hand. On the other hand, if you look at history, the numbers always seem too big at the time, but markets tend to grow so big that it's hard to envision them. There's an example from Peter Lynch where in the early 90s he was looking at McDonald's, and somebody told him, hey, McDonald's is totally saturated, there's no way they can build more stores. And of course he did his own research, he invested in the stock, and it was a multi-bagger from there, because it turns out the market was much bigger than people thought. And I think that's also going to be true about cloud computing. I think the market is going to end up being a lot bigger than people think, because, again, looking at history and looking at the utility that these companies enable for people all around the world. And I was looking, by the way, at IBM yesterday, and it kind of shocked me that IBM still has about 77 billion of revenues. And I read a statistic that there is still 100 billion of spend associated with mainframe computers. And that, by the way, mainframe computers are still sort of, the installed base is still growing, which kind of blows my mind, that you would want to install a monolithic machine on premises when you can just go to, with the elasticity and functionality of the cloud. But then the other part of your question is the conglomerate discount. And I think there's absolutely a conglomerate discount. And I think it's very visible in a company like Alphabet, where you have all these different pieces where you don't know the numbers. You can sort of estimate how much YouTube might be worth, right? YouTube has 1.5 billion users, and Netflix has 180, I think, million subscribers, and you can see how much Netflix is worth and how much YouTube might be worth if it were a separate entity. And you have Weibo, and you have all these different pieces and all the other bets, etc. So Facebook is another great example where they're spending a ton of money on Oculus. I think the number I've heard is $1 billion a year in expenditures there for a division that earns very little revenues at this time. They have Workplace by Facebook, which is a fast-growing SaaS business, enterprise SaaS business, and they have a lot of reinvestment needs right now. They're adding more capacity in data centers than all of AWS, which is kind of mind-blowing. And this is a quote from Zuckerberg. He might have said all of AWS and GCP combined. I have to find the quote, but at least he said it's at least the same capacity that AWS is adding, which is absolutely mind-blowing. So, yeah, I think that there's a lot of discounts in these large conglomerates, and I think part of the reason also is regulatory risk. That my feeling is that there's sort of the valuations are a little bit clamped down by this regulatory risk that we're seeing with all these investigations and antitrust noise that we're seeing, and hopefully that'll subside over time, but we'll have to see.
Marcelo, I have one last question for you. Is Shopify a competitive threat to Square?
Shopify a competitive threat to Square? Look, that's a great question. I think that the what's interesting about payments, and I'm going to use payments as a proxy because Square is primarily payments, is it's fascinating because if you came sort of de novo to this industry and you said, wow, payments, it's a big market, but how many competitors can you possibly have? And then you look at the landscape and sort of all these organisms out there and all these companies, it's just unbelievable, right? It's so fragmented. There are so many different payment processors and different pieces of the value chain that exist between banks and payment and Visa, MasterCard, American Express, et cetera, and then all the other guys building things on top of that, and Stripe and old payment processors like Fiserv and Global Payments, et cetera. It's an enormous market that seems to sustain a number of competitors. Shopify in its merchant business, and they have the Cash App, but in the merchant business, they're really going after the unbanked. And this is the guy who has a coffee shop or a restaurant or a yoga studio, et cetera, and they really traditionally could not get a merchant account, and they're selling in physical retail. And then, of course, from there, they can do things like use software to do online bookings and have a website and all these things. And yes, that starts to touch into what Shopify does, which is sort of the opposite, is starting with the merchant online and then offering them a POS system so that they can tie their data back to the online store. So yes, they are encroaching on each other's territory. And we'll have to see my sense is that, again, the market is so enormous that it'll allow these two to coexist. And of course, Stripe also has a POS system, and Adyen also has a POS system. So my sense is that the market is big enough. And also, these companies, by virtue of them existing, the market structure changes completely. So one quote that I love is there was a recent interview with Toby, the founder of Shopify, and he spoke to a venture capitalist, and the venture capitalist and said, I passed on your company several years ago. I didn't invest because I thought that the TAM was 40,000 merchants in total addressable market. What did I get wrong? And Toby said, nothing. You nailed it. The reason why the TAM was so small is because we didn't exist. And now that we enable so many merchants to easily, frictionlessly go online, that has dramatically increased the TAM. And so you see the rise of things that you couldn't have imagined even a few years ago, like Jeffree Star Cosmetics. This is a YouTube influencer who launches a cosmetics brand and has explosive sales. I mean, the sales were so explosive that they brought down all of Shopify. The future is, again, the future is uncertain. We don't really know what we're going to see. We don't really know the size of these markets. So I think the best we can do as investors is to try to figure out what the best companies are, what the best management teams are, the best positioned businesses, and follow them quarter after quarter and figure out where the market is going. But it's a very tough question, and thank you for asking that.
Well, thank you for joining us. I think this has been the most educational hour we've had in a really long time. So thank you so much. We really, really appreciate your time.
It's been really educational for me as well. Thank you so much. I appreciate doing this.
Thank you very much.
Marcelo.
Yeah.
Thank you.
Nice to meet you.
Yeah.
Nice to meet you. Thank you.
Thanks, John.
Welcome. See y'all guys.
See you guys.
Bye, DJ.